Good afternoon. Thank you all for attending the webinar this afternoon. We are going to talk about the North American oil market, providing an update on basically all aspects of the crude oil supply chain, from supply, demand, movements to inventory. If you have any questions during the webinar, there is a box at the bottom that you can type in any questions that you have as we go along, and then just hit submit. At the end of the webinar, we'll have a Q&A session where we'll hopefully get to all of the questions. If we don't, for some reason, happen to get to your questions at the end, we will be addressing them individually, so you will receive an email from us. So please feel free to submit any questions that you may have. My name is Jody Quinnell. I'm the Oil Products Manager at Genscape on the Spring Rock oil team. I will be joined today by Carl Evans, who is a Senior Crude Oil Analyst at Genscape, and also by Ryan Bocart, who's a Crude Oil Analyst at Genscape as well. Our agenda for the webinar today is really we're going to talk about the North American market and where it's headed in the next couple years. I will cover the crude oil production forecast to talk about what we're seeing on production, where we see production going, both in the U.S. and Canada. I'm then going to hand it over to Carl Evans, who will talk about interregional movements and talk about where all this crude production is being moved across the U.S. Ryan Bocart will then go into our crude runs forecast and where we can expect growth with regards to refinery demand. And then we'll cover imports, what our expectations into the U.S. for crude oil imports are. And then finally, we'll wrap it up with, what this all means for inventories. We have declining production, crude runs that are up, and so what does this mean for the balance as we move into the next couple years? So to start things off, just to talk about some of the major changes that we've seen in the marketplace and how producers are managing this market that they're in. We've seen a price drop of WTI of more than 70% since mid-2014. And really, amongst the producers in the U.S., the theme continues to be survival and to grow when the price is right. So they're really waiting for the right price to hop back into the market to start to increase their activity and all those sorts of things. Hess really kind of eloquently stated it in their last earnings calls, and I think it's somewhat of the theme that came out of the first quarter earnings calls was that, their strategy in this lower for longer price environment is guided by three principles: to preserve their balance sheet, to preserve their operating capabilities, and to preserve growth options so that when the price is right and when they get that signal that they can be able to grow production again. So that was kind of some of the biggest themes that we really came out of the first quarter earnings calls with on the production side of the market. Capex cuts definitely continue to run deep and is driving a lot of the activity that we're seeing currently. So we've seen a 34% cut in Capex from fiscal year 2015 to fiscal year 2016, and almost a 60% cut in Capex from 2014 to 2016. So significant cuts in the amount of spend that producers are spending across the U.S. When it comes to oil and gas activity. At the same time, we're also seeing production guidance being revised down. So we follow all of the major E&P companies, and we have a sample set of about 3.3 million barrels a day of production that we follow and follow how these producers are guiding their production. So it is a sample set, but amongst that sample set of, like I said, some of the largest E&P companies, they are guiding production down 7% from fiscal year 15 to 16. And you'll kind of see this goes along with where we have our production forecast going forward over the next year. At the very bottom of this slide, we have a table that's really just showing the most current announcements versus the company's previous announcements. So more or less, how has Capex changed and how has their production guidance changed from initial estimates? And what we're seeing in this revision is that they producers continue to revise Capex down pretty significantly, but at the same time, they aren't changing their production guidance as much. And some are even, when we look at it on average, are guiding production up. So that comes into play to show that, producers are being more efficient with their spend. Costs are coming down, so they don't have to spend as much to do as much, and efficiencies are up. So that's all the things that are feeding into producers' decisions right now and kind of what we're seeing on Capex and production guidance. So what has all these cuts meant for activity across the U.S.? Well, we've seen a very significant drop in oil rig activity. We think we're very close to bottom now. So we don't think there's going to be a lot more rigs to leave the fleet. Currently, oil rigs are around 323 rigs active, expected to hit 312 in June. So we feel we're basically near the bottom, and we won't see many other rigs leave the fleet. What we do expect to happen is that in the back half of 2016, we're expecting rigs to climb to over 500 by the end of the year. So with this higher price environment, we do expect oil rigs to start to recover and for those to be added back in. This goes along with plans that we've seen by various operators and heard in the latest quarterly conference calls, Pioneer being one of those examples where they plan to add 5 to 10 horizontal rigs in the Permian when the price of oil recovers to $50. They also stated that they would restart their Eagle Ford activity at that $50 price threshold. Also, we heard from Chevron that they have multiple locations within the Permian Basin that offers them a 10% rate of return at around $50 WTI. So it seems like that $50 price level is really a key support level for bringing producers back into some of the core plays of the shale basins across the U.S. One thing I should note, though, is that there is a lag between a price signal and a rig production impact of around 4 to 6 months. So it's going to take some time, even though we're adding rigs the back half of 2016, to realize that production. Because there is that lag between, a producer deciding, okay, now I'm going to put my rig back to work, and then ultimately once they start to get production from that rig. And like I said, it's between 4 and 6 months, and it could, there is risk that this lag could be a little bit longer this time around, as we've laid off quite a few of the workers in the completion side of the industry, as well as on the rig crews and things like that. So getting those workers hired back and all those sorts of things have to come into play and align right to be able to realize production within that 4 to 6 period of time. So when we look at total U.S. production, U.S. crude oil production is declining. We peaked U.S. production at 9.6 million barrels a day in April of 2015, and we've come down to 8.4 million barrels a day is what we're expecting by mid-2017. So we're definitely in a declining pattern when it comes to U.S. production, and we're expecting to lose about 1.2 million barrels a day from peak to trough. After that, with that rig activity coming back the second half of 2016, we feel that we will start to grow production in the back half of 2017 in the U.S., and that it will continue to grow in this price environment with the level of rigs that we've shown previously. Year-on-year changes, we expect U.S. crude production to be down about 660,000 barrels a day year over year this year, and an additional 289,000 barrels a day in 2017. So as we start to grow production, that year-over-year declines will be less in 2017 than what we expect to see in 2016. When we look at it by the individual region and what's contributing to the growth and what areas are contributing most to the overall U.S. decline, the growth engines for 2016 have been the Permian Basin and will be the Gulf of Mexico, with the Gulf of Mexico up 77,000 barrels a day year over year. That is largely driven by a lot of projects that are still coming online that were likely determined when prices were in the $90 to $100 range. Some of the biggest declines we're expecting to see this year are coming from South Texas, 317,000 barrels a day year-over-year decline, and in the Rockies at 243,000 barrels a day year-over-year decline. When we look at 2017, we are expecting Gulf of Mexico to start to decline as some of these newer projects that have come online move into the kind of that declining period of their life cycle. But we are expecting growth from onshore as we start to add those rigs back. The Permian Basin will lead that growth with 161,000 barrels a day of year-on-year growth, and then less decline by far within South Texas, only down 48,000 barrels a day, and the Rockies only down 117,000 barrels a day. One thing that could, and is a topic of conversation, a hot topic of conversation right now, is the drilled but uncompleted inventory. That inventory that's sitting out there could definitely accelerate production. And we're getting into those ranges where producers have said that they would start to complete some of their DUC inventory. Continental, who holds a pretty significant amount of DUCs in both the Bakken and the Scoop, said somewhere in the mid-40s to upper 40s, likely closer to 50, was before they would start to draw down their DUCs. So we think that we're getting into that price range where a lot of these producers are starting to think about their drilled but uncompleted inventory and thinking about starting to work off some of this inventory. Whiting also said about their Bakken and DJ inventory that they will wait until prices stay around $50 for at least 90 days before they start to complete their inventory. We're showing right here North Dakota reported DUCs, so you can see that they've flattened out a bit. They're slightly over 600 DUCs across North Dakota that can start to, that producers might start to work off as we hit these threshold intervals. And across the U.S., we're estimating there's around 3,000 to 3,500 DUCs total across the U.S. But resource constraints may slow the pace of bringing new wells online. So just like there's a lag between production or a price signal and production, we also think that there's risks that due to resource constraints, meaning due to completion crews, not being able to ramp up as quick as producers might want to bring on their DUCs, this could definitely slow the pace of those new wells coming online. And also, just to note that we don't necessarily think once we hit, well, we have almost hit $50, but once we hit that price threshold, that every operator will start to work their DUCs off. There's definitely various plans by each of the individual operators, and so, depending on those operators' plans is going to be dependent upon when we start to work these DUCs over. It's going to be over a period of time. It is going to have an impact on production, but I don't think it's going to have a significant impact all at once on production. And then just, briefly turning over to the key play break-evens and, where some of those break-evens are and why we think that, in this $50 range, we're going to start to see rig activity pick up. The left is the key oil play break-even. And what you can see here and what I'm trying to show more or less is that once we get to the $45 to $50 range, there are a lot of plays across the U.S. that become economic for these producers. So, places such as the, Mississippi Lime, the Midland Permian, the Permian Midland, the Permian Delaware, start to become economic in that range. And so that's why we're anticipating those rigs to start to pick up the back half of 2016 as we are in this increased price environment currently. As we dive into each of these individual regions, one of the key areas that we're expecting, as we saw, to be a growth driver in 16 and 17 is the Permian Basin, and one of the areas where we expect the most amount of rigs to be added back to when we add these rigs back. Very good economics. So you can see Midland Basin around $50 break even at the wellhead, Delaware Basin $56. And really, the Permian continues to attract capital from well-capitalized and well-hedged operators. And for many players, the Permian remains their best play. So that is where they want to, put their capital because it's providing the best returns for them. It's more oily than the Eagle Ford, and realized prices are stronger than the Bakken. Again, another reason why we feel that this will be one of the first areas to attract producers back to. The Eagle Ford, so you can see there's multiple plays across the Eagle Ford and multiple break-evens across those plays. So, you can see anywhere from the high 60s to DeWitt area where the break-even price is $37. And so what we've seen is that in the Eagle Ford, lower for longer prices have seen rigs retreat to the core of the Eagle Ford, with approximately half the rigs operating in Kearns and DeWitt County alone. The lower gas and NGL price weakness has heavily affected Eagle Ford in the first quarter. So the Eagle Ford is definitely more dependent on, and the economics of the plays within the Eagle Ford are more dependent on lower gas, or are more, their economics are more dependent on what gas and NGL prices are than when you look at, for instance, the Permian or the Bakken region. So those were hit pretty hard in the first quarter as we saw weakness in both gas and NGL prices. And then another thing to note about the Eagle Ford is that the areas that are economic at current prices are geographically limited and generally held by only a few operators. So as I was kind of mentioning with the Permian, is that it's a lot larger geographically, and there's a lot more acreage to be drilled than in the Eagle Ford in the current price environment. So another factor is why we think Permian will recover faster than Eagle Ford will recover. And then looking at the Bakken, again, there's very good wellhead break-even prices in the Bakken, under $40 in the
I'm cut out, so we'll just stop there. Something's going on with it. It's okay. It's okay, nobody can hear you. We're just going to do a quick test. Can you hear us, Amanda? Okay, cool. We're going to continue right with Jody.
Okay, sorry about that. I'll go ahead and start over on this slide here. As we seem to have some audio issues go on there. So basically, we went from Eagle Ford, we're now talking about Bakken, and we're showing the Bakken prices here with break-evens, in the $36 range. These are wellhead break-even prices, so you can add, anywhere from $8 to $10 to these prices because of the longer distance to market. So rail prices are a bit, more to get to the locations that crude wants to flow to, and pipeline tariffs are more. So that's, even though the Bakken has lower break-even prices, the realized prices are lower due to proximity to market. And then finally, turning it over to Canadian production and talking about our Canadian production forecast. While the U.S. production has been in this declining pattern, Canadian production continues to grow and has been growing significantly. So forecast has steady bitumen production growth, but conventional production offsetting some of these new volumes. So when we look at 2016, a year-over-year growth, up 100,000 barrels a day for Canada, and then 2017 up 216,000 barrels a day. So slightly up more year over year in 17 as we start to see some of the conventional production declines flatten out a bit and start to add to total crude oil production in Canada. So now I'm going to go ahead and turn the presentation over to Carl Evans, and he's going to talk about movements across the U.S. and also address where all this Canadian production growth is headed.
Cool, thanks, Jody. So moving into the Canadian side of the market, picking up from production, our first kind of area we wanted to highlight is the Canada to PADD 2 movements. Basically, the mid-continent refiners are still the premium market for all Canadian crude grades. Our movements forecast into PADD 2 is calling for just over 200,000 barrels a day year-on-year growth for 2016. Basically, if you take a look at the chart on the left, we can see the Enbridge Clipper expansion, which was added in mid-2015, was basically the last incremental pipe capacity out of Western Canada until later in 2019. Given that only Line 6B, which is past the U.S. border, is the only Lakehead system expansion before 2018, rail will likely be priced into differentials as the market becomes tighter, unless, of course, prices were to push out more conventional production out of Western Canada. Kind of closing out 2016, this Line 6B expansion that we mentioned into Sarnia, Ontario, will allow for more barrels to run into Sarnia and further east into Eastern Canada, but there still will continue to be issues out of Western Canada, especially as production is continuing to grow. So just next, moving to our PADD. Sorry. Next, moving to our Western Canada to Eastern Canada movement. This is kind of our inter-Canadian shipments forecast. The Line 9 reversal and expansion continues to improve for cheaper market access into Eastern Canadian refineries. With production continuing to grow, we see movements from Western into Eastern Canada increasing by just over 60,000 barrels a day in 2016. With the Line 6B expansion that we mentioned earlier, we think this will facilitate increased volumes here, but starting to flatten. The target refineries in this region are Suncor Montreal, Imperial's Nanticoke and Sarnia refineries, Valero Quebec City, Irving St. John, and Silver Range's Come By Chance refinery. So next, moving into kind of PADD 2 movements. First, we're just going to highlight the major rail movements and where we see them, and then move on to pipe. Here, the two charts we have is PADD 2 to PADD 1, which is your Bakken rail volumes into the East Coast, and then PADD 2 to PADD 5. These declining rail movements are largely due to the Bakken cash prices strengthening significantly against Brent, which largely doesn't cover transportation costs, which we have at around $13 per barrel plus to the East Coast and about $9 plus to the West Coast. Also, with production declining and the Dakota Access Pipeline coming online late 2016-2017, cash prices are likely to remain strong going forward. So this kind of reinforces our view that there'll be plenty of pipe capacity out of the Bakken. For PADD 2 movements to the East Coast, we see volumes coming from about 330,000 barrels a day this year down to about 265 by the year end of 2016, a decline of about 65,000 barrels a day. For PADD 2 movements to the West Coast, we have volumes coming in at about 126,000 barrels a day down to just over 100,000 barrels a day year end 2016, which is about a decline of 20,000 barrels a day. So as mentioned, moving on to the PADD 2 to PADD 3 movements. With increased market access via Flanagan South, Market Link, Seaway, and Seaway Twin, flows from PADD 2 are expected to continue. Here we have interregional flows from PADD 2 to PADD 3 at about 50,000 barrels a day year on year. As you can see in the chart on the left, Genscape's proprietary pipeline flow data allows us to track real-time pipeline movements. So, this is in particular Phillips 66, Pegasus, Seaway Twin, and Seaway Market Link, which is basically all the major trunk lines between regions, and we use this to reinforce our forecast for the movements here, especially by pipe. Next, moving to the PADD 2 to PADD 4 movement. So this is kind of Bakken movements, largely moving into the Denver Rockies region. New capacity like Dubuque, Belforche, and Double H pipelines will continue to move volumes into PADD 4 and back out into Cushing and Patoka. We have interregional flows from PADD 2 to PADD 4 only growing at about 20,000 barrels a day in 2016. And this represents another pipeline outlet that will continue to reduce rail volumes out of the Bakken and increasingly more flows into Cushing and further south into the Gulf Coast. Especially if you note the recent volumes through late 2015-2016, we've seen incremental volumes move out of rail and onto pipelines, and you can see it in these movements by pipe into PADD 4, especially as new expansions have come online in the last 2 years. So next, moving from to PADD 4, from PADD 4 into PADD 2. This is kind of like I just mentioned earlier, the movements in the Bakken and then into PADD 4 and then out to PADD 2. Pipelines such as White Cliffs, Pony Express, and Platte give plenty of capacity to clear declining production volumes. Saddlehorn Pipeline coming online in late 2016 will add an incremental 190,000 barrels a day of takeaway. Also, Bakken flows into PADD 4 do act as supply into the region as DJ volumes are declining slightly quicker than those in the Bakken. And we also have, that being said, we have interregional flows from PADD 4 to PADD 2 even for 2016. And just to kind of summarize here, with Canadian imports into PADD 4 flat and production in the DJ and Bakken expected to decline in 2016, we're not expecting significant movements out of this region to be substantial enough to fill the current and new infrastructure in the coming 3 years. And you can see this with basically the movements from PADD 4 to PADD 2 declining over the next 3 years, and basically that this region is largely overbuilt, especially with Saddlehorn coming on later this year. You can see that in current utilization rates even before Saddlehorn, and we expect this to be more of the case moving forward into 2017 and 18. So next, looking at PADD 3 to PADD 2 movements. Basically here, pipeline capacity can easily handle crude flows from the Permian into Cushing with room to bring imports up via the Capline. Here we have interregional flows from PADD 3 to PADD 2 at about down about 150,000 barrels a day year on year in 2016. Genscape's proprietary pipeline flow monitors allows us to track Capline, Basin, Mid-Valley, and Centurion, which we can compare against these pipeline movements and track this forecast real time. And basically, current flows are showing temporary increased volumes on Mid-Valley and Capline, which we think is likely due to the production outages due to Canadian wildfires over the last month. That being said, just a few more notes around why we see these volumes declining over time. The WTI Midland and WTI WTS differentials are barely supporting pipeline movements into Cushing. This reinforces our PADD 3 to PADD 2 pipe movements decreasing in the next year. Also, basically, from our best understanding, these flows into PADD 2 are largely contracted volumes, as the cash differentials don't seem to support these pipe movements up into the mid-continent. So that's why we have this kind of slowly decreasing, but knowing that there are needs for some of this crude to move into PADD 2. So lastly, for our balance forecast, we'll just focus a little bit on world imports. I'm just looking to the left on at total U.S. and then highlighting PADD 3. Here we assume world imports in the U.S. at about 350,000 barrels a day, plus 350 year on year in 2016, but then down about 225 year on year in 2017. We assume world imports into PADD 3 at about 100,000 barrels a day growth year on year, but then down about 300 in 2017. For Canadian imports, we have them averaging about 3.3 million barrels a day in 2016, which represents a growth of about 160,000 barrels a day year on year. So one thing to keep in mind here is that our world imports forecast is a very key assumption to this model, especially given an OPEC basket price of negative $5 below WTI. We think this should encourage world imports to place into the Gulf Coast especially. But one thing to mention, just to kind of wrap it up on the world imports, is that we do have world imports coming off from current levels, especially from the start of this year through 16 into 17. This is a very crucial assumption that needs to come true for North American inventories to continue draws into late 16 and 17. And so it's something we continue to track very closely, as it is a key indicator as to whether or not we're going to see the draws that the market is expecting. And now I'll just move over to my counterpart here, Ryan, who's going to talk to us a little bit more about North American crude oil demand and our views around that. Here you go, Ryan.
Thank you very much, Carl. So to get into the demand side, we expect 2016 North American crude demand to be just as strong as 2015. And to break it down just between the U.S. and Canada, we have the U.S. growing at 229,000 barrels a day year over year for 2016, and we have Canada slightly laggard at negative 14,000 barrels a day year over year. For U.S. growth, the primary drivers behind that are the CDU capacity expansions that have taken place over the course of this year, and we'll dive into this a little bit deeper in a slide or two. And the second thing driving U.S. growth will be strong product demand through the summer, of course, with summer driving season helping gasoline demand out. And we also think that there are signs that the overhang in distillate inventories are actually starting to get worked off as we enter the summertime. On the Canadian side, we see runs weighted down by lackluster first half 2016 utilization rates. The latest public data for Canada show utilizations at around 69%, which you'll see clearly on that chart on the right, the dip in May runs there. Outages in May have been higher than expected, with both Imperial and Suncor having maintenance events this month at their refineries in Canada. Another thing is that the low point in the Canadian runs in May also contribute to slower draws and inventories due to the wildfires. So you'd expect that with the wildfires in place, there would be more pull out of inventory due to the disruption in supply. But the fact that demand there is less, we can kind of see that helping those stock levels kind of stay somewhat steady and not draw down very largely. Just to break it down by region, we have PADD 1 at plus 21,000 barrels a day, PADD 2 and PADD 3 leading growth at plus 68,000 and plus 138,000 barrels a day, PADD 4 at plus 9,000 barrels a day, and then again, Canada and PADD 5 a little laggardly, PADD 5 at negative 7,000 barrels a day and Canada at negative 14,000 barrels a day. Diving into a closer look at PADD 2, the chart on the left, if you look closely, is the bars are just showing the year-over-year growth in runs, and the lines itself are just showing the year-over-year utilization rate change. So by the bars kind of in the dark blue being positive there through 2017, we expect that runs will be strong through 2017. And for PADD 2, we have 2016 at, again, 68,000 barrel a day growth year over year. And for 2017, we have it at plus 57,000 barrels a day. A couple of things to note kind of about PADD 2, especially for 2016. In the first and second quarter of the year, there were pretty high levels of turnaround activity. In April, especially, you had Husky Lima, Marathon Robinson with plant-wide turnarounds ongoing. And there was also outages or other downtime reported at BP Whiting and WRB Wood River, just to highlight kind of a few of the larger outages there. And secondly, you'll see that the October 2016 year-over-year run growth is pretty large. It's just north of 500,000 barrels a day over 2015. That's not necessarily because we see an incredibly strong 2016 in October. It's simply because October 2015 was extremely low on the run side, where utilization rates were in the realm of 77.6%, which is, from what I saw, a record low for PADD 2 utilization rates. So we certainly expect better runs to kind of occur during that month than over 2015. So to get back to the growth story for PADD 2, again, it focuses on, as Carl mentioned, there are growing imports from Western Canada into PADD 2, and we see a lot of refiners there gearing their facilities to be able to take more of that heavy crude. So just to give a few quick examples of projects like that, Husky Lima just finished their plant-wide turnaround at kind of the end of April, beginning of May, and that initiated work on their 40,000 barrel a day crude flexibility project. It doesn't necessarily expand their crude throughput per se, but it does allow them to run a heavier slate, and that's also that's accepting more output from Husky's Sunrise project in Western Canada. And then if you look back to like 2015, BP Husky Toledo also expanded their coker there and modified their crude unit, and again, that was at the Toledo refinery. So again, Husky working to push more of their upstream production into their downstream facilities to realize the synergies that come from that. Two other brief examples of refineries kind of gearing up to take more heavy. WRB Wood River is in the process of modernizing their FCC unit to take heavier crude, and CHS McPherson added or replaced their coker in February and March of this year. So that actually expanded their coking capacity, and it'll also add the benefit of more crude being able to be pushed through there. Looking back to February, Pad 2 was also the hotspot for the economic run cuts that we saw. And so the chart on the right is just showing the WTI 2-1-1 indicator using Chicago market pricing for those products in that crack spread. What we've seen is, yes, there were record lows that were hit in February and March, but at the same time, we've seen improvement even over the last 3 weeks in kind of the near-term part of the curve, not necessarily on the back end. But those crack spreads are kind of tending back towards more normalized, somewhat more normalized levels. Shifting our focus to Pad 3, what you'll see on these charts here is it's actually charting the Texas RRC run data against the latest data point for the EIA calendar day CDU capacity and the EIA historicals. So again, like Pad 2, Pad 3 will be the largest growth area for crude oil demand in the U.S. We have it at plus 138,000 barrels a day year over year. And the reason why I chose these 4 refineries out of all the refineries in Texas is to highlight that refineries in each area of Texas are pushing their calendar day CDU capacity. So you have kind of the southwest part with WNR El Paso, the Panhandle with WRB Borger, and then covering the Gulf Coast with Motiva Port Arthur and Citgo Corpus Christi. And as a result of that, we've seen, as a result of this trend and kind of runs being very close to capacity, we are seeing kind of the largest CDU capacity additions in Pad 3. Notably, and we'll touch on this in the next slide, but Valero alone is adding 160,000 barrels a day of crude capacity at their Houston and Corpus Christi refineries by the first half of this year. There's also several condensate splitter projects that are in the works, and the nearest one to completion is Magellan Trafiguero's Corpus Christi facility, which is according to Magellan's last quarterly conference call, it's on track to be in service in Q4 of 2016. So to just give a kind of a more blanket overview as to where we're seeing this incremental CDU capacity added, again, a lot of it is in those the regions that we focus on here, Pad 2 and Pad 3. Again, Valero investing heavily in new crude capacity. But also there's a couple of debottlenecking projects that HollyFrontier is undertaking to expand their crude throughput a little bit. And another kind of noteworthy area is Pad 4. There's only two main expansions that we've kind of tracked. One being at Calumet Great Falls, and the other being at HollyFrontier Woods Cross. But between those two, they're adding approximately 29,000 barrels a day of crude throughput, which is, given that Pad 4 is such a small refining area, that's a 4+% increase, 4+% increase in crude throughput in that particular region. And again, a lot of those projects are geared towards being able to run a heavier slate to take advantage of those kind of the Western Canadian crude discounts. So what could offset this CDU capacity expansion are outages. And you'll see here this is what we're anticipating as far as total barrels per day that will be offline due to planned outages. So you'll see that the first half of this year is relatively heavy. Those turnarounds that I was speaking about a few slides ago in April, especially in PADD 2 and PADD 3 are reflected there. But in total, for September of this year, we have just over 800,000 barrels a day possible being offline if those planned works actually stay on schedule and are executed well. So several of the refineries to highlight in the fall that are taking planned work. In PADD 2, we have BP Whiting, Western Refining, St. Paul Park, also Northern Tier, Valero Ardmore as well. And in PADD 3, we have Marathon Galveston and Marathon Garyville, both having planned work. Again, those are two of the kind of the top 5 largest refineries in the U.S. And there's also we also have planned work at Valero Port Arthur, Western Refining El Paso, and PBF Chalmette. So we have a boon in, we have kind of a pro-growth prospect, and the capacity expansions possibly offset by the planned outages that we just talked about. Another kind of the other growth area that will certainly help runs will be in the product markets. And to drill down a little bit further into the distillate market, what we're seeing here is signs that the distillate market is correcting. Just looking at the EIA's weekly data for total U.S. distillate imports, we have those imports decreasing at 120,000 barrels a day year over year, year to date, and on the export side, we have that growing at 60,000 barrels a day year over year, year to date, and that's kind of goes along with the story that a lot of refiners told in their last quarterly conference calls, in that they will rely on the export market to clear a lot of the excess distillate inventories, and they were particularly looking to strong demand in Latin America to kind of help that along. And as we've kind of approached summer, in the chart on the bottom left, you'll see that refinery net production of distillates has decreased at 144,000 barrels a day year over year, again year to date. And that's reflected in a lot of refineries responding to those crack spreads and basically switching over to that max gasoline mode as the summer driving season approached. And I guess all in all here, with the imports, considering the imports, exports, and the distillates, those distillate stocks are still up by 30.6 million barrels year over year, year to date. But you can kind of see it trickling down into a more normalized level as we get into the summer. Lastly, just looking to several refiners that report their kind of proprietary indicators for their investors to follow. Looking at three in particular, Marathon, Valero, and HollyFrontier. These 3 refiners represent a very large chunk of domestic refining capacity. You'll see that the changes between February and the spreads have rebounded considerably since early February. If you look to Marathon's Mid-Con indicator, it was actually negative, and that reflected, again, those economic run cuts in early to mid-February. But we've seen it strengthen by about $7.50 since its last reporting in early May. Another few to highlight here, Valero's West Coast indicator has more than doubled from about $9.30 to $18.85, and HollyFrontier's Southwest indicator grew from $9.21 in early February to more than doubled up to $19.72. So just to wrap up the demand section, again, the main drivers are going to be those capacity expansions, leading run growth, offset slightly by those outages kind of later this year, and also aided along potentially by how product demand comes in for the summertime. And based on the indicators that we've seen, that product demand could come in very strong. to sum things all up and try to package it up for you guys in a semi-tidy manner here, looking to inventories now. What we're seeing in PADD 2 is that, again, through the summer with that strong product demand, those crude inventories will draw by approximately 3.7 million barrels a day from Q2 to Q3. And we see a similar story in PADD 3. We see inventories coming down by 4.4 million barrels a day from Q2 to Q3. At the same time, PADD 2 will still exit 2016 building by 12.8 million barrels, and PADD 3 will exit 2016 still building 39.4 million barrels year over year. Looking to the U.S. as a whole, again, this is just going back to summarizing all the points that Jody and Carl and myself have made. So we see that demand will soften into the fall, not supporting further draws past late summer. We see lower production, but possible signals from producers at the $50 to $60 range that they will complete their drilled and uncompleted wells and also bring back new rigs to kind of drill their existing inventory. And we see imports still being competitive, as Carl noted. OPEC is being very aggressive in how they price their barrels into the Gulf Coast, and we've also seen a number of different grades kind of make their way into even the East Coast as well. So in order to balance, we do see that the imports, kind of those world imports, that portion of the puzzle, that must fall if the production comes back online in order to get to a more balanced U.S. crude oil market. So that summarizes the kind of the inventory section. I'll turn it over to Carl for some brief concluding remarks.
Cool, thanks, Ryan. So a few key takeaways here, and then we'll move over to a few questions just to wrap everything up. So on the production front, rig activity is anticipated to pick up second half of 2016, reversing U.S. production declines in mid-2017. We expect Canadian production growth driven by oil sands production expected to increase through 2016 and 2017. Also, that DUCs, drilled but uncompleted wells, could accelerate production growth if they were to come online, especially with prices approaching the $50 range. But we also see this $50 to $60 range is when these really start to get turned on. From the movements perspective, pipeline capacity has caught up with production. Rail will be less prominent as a transport method in the coming years. And that being said, we do expect Canadian imports still to grow for the next 3 years, moving in largely into PADD 2, PADD 3 markets. For refinery runs, as Ryan was saying, PADD 2 and PADD 3 are driving the crude runs growth forecast. The crack margins are showing rebound moving into the summer, and product demand is an ongoing factor that we're continuing to watch on this. And lastly, on the balance side, we believe the market is trying to rebalance with lower production volumes, which we're seeing incrementally each month, but imports continue to fight for this market share in the U.S. If production starts to pick up as prices picks up in the next 6 months, imports are going to have to fall, and is a crucial part of inventories not reaching capacity limits. So something we're continuing to watch, especially, and we do expect imports to come off as world production does begin to decline, to come off from current levels. But that's a very key assumption that we need to see starting to happen this year, or else we're going to be in a very similar boat as we were earlier this year in terms of inventories. And from there, we're going to look at a few questions. We'll just mute for a second here, pick out a few, and then we'll just reiterate them. And feel free to submit any questions into the box if you guys have them. Thanks. So one of our first questions here, the question is, how have the fires in Alberta impacted your Canadian production forecast? So in terms of how it's impacted, our kind of story here has been really to focus on how the fires are taking out unplanned volumes that were supposed to be produced, and not what was already planned, especially on the upgrader side. So we had essentially had, except for the CNRL Horizon upgrader, which is supposed to take a turnaround in July, all the other 4 upgraders taking turnarounds over this period, which was significantly impacting production over April and still through May. And some of the research we've seen out there didn't include, especially the Scotford upgrader, and I think that's just because there's not a lot of info on it, and we do have IR cams to watch that so we can see when that upgrader is taking a turnaround. So that being said, largely the outages that we have factored in for May have been on the synthetic side. We've seen some reduced volumes in the bitumen grades, but largely it's been on the upgrader side. We think that these will temporarily impact production likely through just the beginning of June as they ramp back up, because there was, from what we've read, a few delays on planned maintenance that would just carry forward a week or two. But we do see, and we were starting to see it already in the EIA weekly imports number from Canada. They've come off, but we do expect, like I said, we can get specific numbers on it later, but we do expect largely the impacts to be in May, slightly carry through June, but production to largely pick right back up where it left off and can continue growing through the rest of the year.
All right, so there was a question here on production. Will producers look at the forward curve and hedge above $50, or will they wait for the spot price to reach $50? And, you know, it's definitely variable depending on the operator. So I would say it's very operator specific. I'm sure that there are operators out there right now that are definitely hedging into this price environment to start to pick up activity like we're anticipating the back half of 2016. So, you know, we definitely feel that there's some producers who might operate more on a spot basis, but there are definitely producers right now who I'm sure are hedging some of their volumes and hedging some of their future activity into the curve right now in this $50 environment. And then there was another question to follow up with that. At what price will DUCs be activated? And again, I'm going to say that, you know, it's a varying price for sure, depending on the operator and, you know, their environment and what they're looking at. We've seen kind of 2 trains of thoughts with DUCs in a way. One train of thought is that there's actually producers who, you know, in their first quarter, in their conference calls were saying, we're going to start working off DUCs right now, even in this lower price environment, and that's, you know, maybe when prices were more in the $40 range. They were actually going to start working off some of their DUC inventory to keep their production volumes more or less flat. And then you had another group of operators who were saying, no, we're not going to complete them now. We're okay with our production declining slightly, or we're going to keep up. But we're going to continue to drill these wells because it's so cheap to drill them. You know, costs are down 50%, so we're going to continue to drill the wells, but we're going to wait to complete them until we get to prices of $50 to $60. So it's definitely variable by the producers and what their plans are. But I would say the majority of what we heard about DUCs is that they potentially will come online in that $50 to $60 range. I think is kind of a key assumption around that. And then another question to follow up with that on production is, you know, I talked about, the question is 9.6 million barrels today to 8.4 million barrels a day represents a 12% reduction in production. And I had showed a slide where earlier I showed guidance that was guided down from 15 to 16 of 17%. And so how do we reconcile these discrepancies? Basically, the 9.6 to 8.4 is total declines from peak to trough, and the 7% decline is average of 2015 to average of 2016. So that's the reason for the little bit of discrepancy in the 12% to 7%. It's just more or less outright peak to trough versus the average.
And then we had a few questions just on the distillate side. So the chart that we showed there, that's just looking at total distillates all in. So it's also the higher sulfur as well as the kind of the lower sulfur there. We haven't looked, we didn't break out necessarily each individual product there, just looking at the market as a whole, but that's something that we'll look at into the future. Another person asked about the spread between heating oil and RBOB. Since that has kind of narrowed a little bit more, will we see diesel yields? Will we see refiners kind of, or I guess, will we see the decline in diesel yields kind of stop? And I think we'll see refiners run max gasoline obviously through the summertime. You had a couple of refiners in their Q1 call saying that it's basically going to take a cold winter to fully rectify and balance the market. So going into the wintertime, I can definitely see that happening. But as far as summertime, I think we will continue to see kind of the yields that we're seeing now.
So at this time, we're going to go ahead and wrap up the webinar. We want to thank you all very much for attending, and we hope you found this valuable. If we didn't get to your question, like I said before, we will go ahead and address them individually to you. But again, thank you all very much for attending, and we will talk with you all soon. Bye-bye.